Introduction. What the book is about. Investment versus speculation. Investing and speculation are two distinct approaches to engaging with the financial markets, and understanding their differences is crucial for anyone looking to grow their wealth responsibly. Investment is fundamentally about the careful, calculated, and thoughtful allocation of capital, with the goal of achieving a return over the long term. It involves a commitment to research, analysis, and a deep understanding of the assets in which one invests. Investors typically look for opportunities that are undervalued by the market, with the belief that over time, the intrinsic value of these assets will be recognized, leading to appreciation in their price. The focus is on value, quality, and sustainability, ensuring that the principal investment is protected and that the returns are commensurate with the risks taken. On the other hand, speculation is more about capitalizing on market price movements, often over the short term. Speculators are less concerned with the intrinsic value of an asset and more focused on market trends, price fluctuations, and timing. They might buy into assets hoping that others will soon drive the price higher, enabling them to sell at a profit. While speculation can offer substantial gains in a short period, it also comes with significantly higher risks. The approach is less about deep analysis and more about predictions and timing, which can be unpredictable and often lead to substantial losses. Understanding the distinction between investment and speculation is crucial for developing a strategy that aligns with your financial goals and risk tolerance. While investing is generally a safer and more stable path to building wealth over time, speculation might appeal to those seeking quick gains, though it requires a high tolerance for risk. Investor types. When it comes to investment strategies, individuals generally fall into two broad categories: the defensive investor and the enterprising investor. Each type represents a different approach to managing one's portfolio based on the investor's temperament, time commitment, and risk tolerance. The defensive investor. The defensive investor, also known as the passive investor, prioritizes the preservation of capital over higher returns. Their primary goal is to achieve a reasonable return while minimizing risk and effort. Defensive investors typically have a lower tolerance for risk and prefer investments that offer stability and predictability, such as high-quality bonds, dividend-paying stocks, and blue-chip companies. They are less likely to engage in frequent buying and selling, instead opting for a buy-and-hold strategy that emphasizes long-term growth. A defensive investor's portfolio is usually well diversified to spread risk across different asset classes and industries. They tend to avoid complex investment strategies, preferring simplicity and consistency. This approach requires less time and effort, as defensive investors rely more on established companies with strong financials, rather than trying to identify under-the-radar opportunities. The defensive investor's philosophy is rooted in patience and discipline, understanding that consistent, moderate returns are preferable to the volatility of high-risk investments. This approach is well suited for those who may not have the time or desire to actively manage their investments, but still wish to see their wealth grow steadily over time. The enterprising investor. The enterprising investor, or active investor, seeks to achieve higher returns by taking on more risk and actively managing their investments. This type of investor is willing to dedicate significant time and effort to research, analysis, and monitoring the market. They are constantly on the lookout for undervalued stocks, special situations, or other opportunities that have the potential for significant gains. Enterprising investors are more likely to delve into detailed financial analysis, study market trends, and use a variety of investment strategies to outperform the broader market. They might invest in smaller, emerging companies, engage in value investing by picking stocks that are temporarily undervalued, or even participate in arbitrage opportunities. Unlike the defensive investor, the enterprising investor is more comfortable with volatility and understands that higher rewards often come with higher risks. This type of investor is not just looking to preserve capital, but actively seeks to grow it through informed decision-making and a willingness to take calculated risks. The enterprising investor thrives on the challenge of beating the market and is not deterred by the occasional setbacks that are part and parcel of an active investment strategy. Chapter 1: Investment and Speculation. Characteristics of speculation. Speculation is a practice that is deeply embedded in the behavior of the stock market, driven by the desire for quick profits and the allure of rapid wealth accumulation. However, the speculative approach to the market is fraught with risks and uncertainties that can easily lead to significant losses. At its core, speculation involves making financial decisions based on the anticipation of future price movements, rather than on the intrinsic value of the asset itself. Speculators often focus on market trends, momentum, and external factors such as news, economic events, or even rumors that might influence the price of an asset in the short term. They seek to buy low and sell high, timing the market to capitalize on these fluctuations. The speculative nature of the market is characterized by several key traits. Short-term horizon. Speculators typically operate with a short-term outlook, looking to profit from quick price changes. This could mean holding an asset for a few days, weeks, or even hours. The rapid turnover of assets is a hallmark of speculation, where the focus is on immediate gains rather than long-term value. High risk and high reward. Speculation is inherently risky because it relies on predicting price movements, which are often unpredictable and influenced by numerous external factors. The potential for loss is high. However, this high risk is also what drives the possibility of high rewards, as successful speculation can lead to substantial profits in a short period. Market timing. Successful speculation requires precise timing, which is notoriously difficult to achieve consistently. Speculators must buy at the right moment and sell just before the market turns. This necessity for perfect timing often leads to stress, anxiety, and the potential for significant financial loss if the market does not move as anticipated. Emotional decision-making. Speculation is often driven by emotions such as greed and fear. The pressure to act quickly can lead to impulsive decisions based on market noise rather than sound analysis. This emotional aspect of speculation makes it challenging to maintain discipline and stick to a rational investment strategy. Leverage. Many speculators use leverage, borrowing money to increase their market exposure and amplify potential returns. While leverage can magnify gains, it also magnifies losses, often leading to a situation where a single bad trade can wipe out significant portions of capital. Speculation, while potentially lucrative, is akin to gambling in many respects. It lacks the foundation of thorough analysis and is often based on assumptions and predictions that may not materialize. As such, those who engage in speculation must be prepared for the possibility of substantial financial loss. Characteristics of investment. In contrast to speculation, investment is a disciplined and systematic approach to growing wealth over time, grounded in careful analysis, risk management, and a focus on long-term value. Investors prioritize the safety of their principal and seek to achieve adequate returns through informed decision-making and a well-thought-out strategy. The characteristics of a sound investment strategy include thorough analysis. Investment begins with comprehensive research and analysis. This involves evaluating the financial health, management quality, competitive position, and long-term prospects of a company or asset. Investors analyze financial statements, assess market trends, and consider economic conditions before committing their capital. The goal is to understand the intrinsic value of the asset and determine whether it is currently undervalued or overvalued by the market. Safety of principal. A key principle of investing is the preservation of capital. Investors are cautious about where they place their money, seeking to minimize the risk of loss. This involves selecting investments that are less likely to experience significant downturns or volatility. Safety of principal is often prioritized through diversification, choosing high-quality assets, and avoiding speculative ventures. Adequate return. While safety is important, investment also seeks to achieve an adequate return that compensates for the risk taken. Investors look for opportunities that offer a reasonable rate of return based on the inherent risks of the investment. The return is not expected to be extraordinary or immediate, but should be sufficient over the long term to justify the investment. This balance between risk and return is central to successful investing. Long-term perspective. Investment is inherently a long-term endeavor. Investors are patient, understanding that real value often takes time to emerge. They are not swayed by short-term market fluctuations or temporary setbacks, but maintain a focus on the long-term potential of their investments. This long-term perspective allows investors to ride out market volatility and benefit from the compounding effect of returns over time. Rational decision-making. Investment requires a rational, unemotional approach. Investors make decisions based on facts, data, and logical analysis rather than on emotions or market hype. They develop and adhere to a disciplined strategy, avoiding the temptation to chase after trends or react impulsively to market movements. Rationality ensures that investment decisions are aligned with the investor's goals and risk tolerance. Margin of safety. A cornerstone of investment philosophy is the concept of a margin of safety. This means purchasing an asset at a price significantly below its estimated intrinsic value, providing a cushion against errors in analysis or unforeseen market events. The margin of safety reduces the risk of loss and increases the potential for gain, making it a crucial element of prudent investing. Chapter 2. The Investor and Inflation. Inflation risk. Inflation, the gradual increase in prices over time, poses a significant risk to investors because it erodes the purchasing power of money. When inflation rises, each dollar you hold buys less than it did before, which can severely impact your investment returns if not properly managed. Inflation is often referred to as the silent thief because its effects are not immediately noticeable but can be devastating over the long term. For example, if inflation averages 3% per year, the value of a dollar will be cut in half in roughly 24 years. This means that without accounting for inflation, even investments that appear to generate a positive return might be losing real value. The impact of inflation is particularly concerning for fixed income investments like bonds or savings accounts, where returns are generally fixed in nominal terms. As inflation rises, the real return on these investments, calculated as the nominal return minus the inflation rate, can become negative, meaning that the purchasing power of the returns is decreasing over time. For example, a bond yielding 4% might seem attractive, but if inflation is 5%, the real return is negative 1%, leading to a net loss in purchasing power. Inflation also affects other asset classes, including stocks, though the impact can vary. Companies with strong pricing power, meaning they can raise prices without losing customers, might pass on higher costs to consumers, potentially maintaining or even increasing their profitability. However, companies with limited pricing power may see their profit margins squeezed, leading to lower returns for investors. Understanding inflation risk is crucial for investors because it affects the real, inflation-adjusted returns of their portfolios. Ignoring inflation can lead to a false sense of security, where nominal gains mask the erosion of purchasing power over time. Protection against inflation. Given the risks posed by inflation, it's essential for investors to take proactive steps to protect their portfolios from its effects. There are several strategies that can help mitigate the impact of inflation and preserve the real value of your investments. Investing in equities. Equities, or stocks, are often considered one of the best hedges against inflation. Over the long term, the value of stocks tends to rise at a rate that outpaces inflation, as companies can increase prices for their goods and services, leading to higher revenues and profits. This growth can translate into higher stock prices and dividends, which can help offset the impact of rising prices. However, it's important to choose companies with strong fundamentals and the ability to maintain profitability in an inflationary environment. Inflation-protected securities. Another effective way to safeguard your investments from inflation is by investing in inflation-protected securities. These are bonds that are specifically designed to protect against inflation. In the United States, Treasury inflation-protected securities, TIPS, are a popular option. The principal value of TIPS adjusts with inflation, as measured by the Consumer Price Index, CPI, ensuring that both the interest payments and the principal repayment keep pace with rising prices. This makes TIPS an attractive option for conservative investors looking to preserve capital in real terms. Real assets. Real assets, such as real estate, commodities, and natural resources, can also provide protection against inflation. Real estate, in particular, tends to appreciate in value over time, often at a rate that exceeds inflation. Additionally, rental income from real estate can increase with inflation, providing a steady stream of income that maintains its purchasing power. Commodities, such as gold, oil, and agricultural products, often see their prices rise during periods of inflation, making them a useful hedge. Investing in tangible assets that have intrinsic value can help diversify your portfolio and protect against the devaluation of currency. Diversification. Across asset classes. Diversification is a key strategy for managing inflation risk. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you can reduce the impact of inflation on your overall portfolio. While some assets may underperform during inflationary periods, others may perform well, helping to balance out the overall return. A well-diversified portfolio is more resilient to the varying effects of inflation on different asset types. Dividend-paying stocks. Companies that pay dividends, especially those with a history of increasing their dividends over time, can provide an additional layer of protection against inflation. As inflation rises, these companies may be able to raise their prices and pass on the higher costs to consumers, allowing them to maintain or increase their dividend payments. Dividends can provide a source of income that grows with inflation, helping to preserve purchasing power. Alternative investments. In some cases, alternative investments such as infrastructure, private equity, or hedge funds may offer inflation protection. These investments often have low correlations with traditional asset classes and may perform well in different economic environments. However, they typically come with higher risks and fees, so they should be approached with caution and only considered as part of a diversified portfolio. International investments. Investing in international markets, especially in countries with lower inflation rates or stronger currencies, can also help mitigate inflation risk. By diversifying globally, you reduce the dependence on any single economy or currency, which can be beneficial if inflation is particularly high in your home country. Chapter 3. A Century of Stock Market History. Market Fluctuations. The history of the stock market over the past century is a tale of dramatic fluctuations, characterized by periods of exuberant booms and sobering busts. These market fluctuations are a natural part of the financial landscape, reflecting the ever-changing dynamics of the economy, investor sentiment, and external events. Over the years, the stock market has experienced numerous cycles of expansion and contraction. During booms, market optimism drives asset prices to new heights. These periods are often fueled by strong economic growth, technological advancements, and a general sense of confidence among investors. People are eager to invest, believing that the good times will continue indefinitely. However, this optimism can sometimes lead to speculative bubbles, where asset prices rise far beyond their intrinsic value. Eventually, every boom is followed by a bust. When the market's optimism reaches unsustainable levels, it can only take a small trigger, a disappointing earnings report, an economic slowdown, or even geopolitical tensions to reverse the trend. Panic sets in, and investors rush to sell, leading to sharp declines in asset prices. These downturns can be swift and severe, wiping out substantial wealth in a short period. The stock market's history is marked by several significant events that highlight these fluctuations. For instance, the Great Depression of the 1930s began with the stock market crash of 1929, when the speculative bubble of the 1920s burst, leading to a prolonged period of economic hardship. Similarly, the dot-com bubble of the late 1990s saw technology stocks soar to unprecedented levels, only to crash in the early 2000s when the reality of unsustainable valuations became evident. More recently, the 2008 financial crisis serves as another example of how quickly market conditions can change. What began as a housing market downturn in the United States quickly escalated into a global financial crisis, leading to a severe market decline and a deep recession. Despite these dramatic events, the market has always recovered over time, often reaching new highs in subsequent years. Lessons from history. The cyclical nature of the stock market is perhaps its most defining characteristic. History teaches us that markets move in cycles, with periods of growth inevitably followed by periods of decline. Understanding this cyclical nature is essential for any investor, as it helps to manage expectations and avoid common pitfalls. One of the most important lessons from history is the importance of patience. Market downturns, while painful, are temporary. The market has always recovered, and those who remain patient and committed to their investment strategy are typically rewarded in the long run. During periods of market stress, it can be tempting to sell off investments and retreat to safer assets. However, history shows that those who sell during downturns often lock in losses and miss out on the recovery that follows. Patience is particularly important during periods of market volatility. When prices are swinging wildly, it's easy to become emotional and make decisions based on fear or greed. However, successful investors understand that volatility is a normal part of the market and that it's essential to stay focused on long-term goals. By maintaining a disciplined approach, investors can ride out the short-term fluctuations and benefit from the long-term upward trend of the market. Another key lesson is the value of diversification. Market history is full of examples where specific sectors or asset classes have experienced significant declines, while others have remained relatively stable or even gained. Diversifying across different sectors, asset classes, and geographies helps to spread risk and reduce the impact of any single market event on the overall portfolio. This approach allows investors to participate in market growth while mitigating the effects of downturns. Moreover, history underscores the importance of valuation. Booms are often characterized by overvaluation, where asset prices are driven far beyond their intrinsic worth. Conversely, busts can create opportunities to buy quality assets at discounted prices. By focusing on valuation and investing in assets that offer a margin of safety, investors can avoid the pitfalls of buying into bubbles and take advantage of opportunities during market downturns. Finally, history reminds us of the role of emotion in investing. Market cycles are often driven by human behavior, fear during downturns, and greed during booms. Recognizing these emotional drivers and maintaining a rational approach is crucial for long-term success. Investors who can detach themselves from the emotional roller coaster of the market and stick to a well-thought-out plan are more likely to achieve their financial goals. Chapter 4. General Portfolio. Policy: the defensive investor. Asset allocation. For the defensive investor, the cornerstone of a sound investment strategy lies in asset allocation, which involves distributing investments across different asset classes, primarily stocks and bonds. The defensive investor prioritizes the preservation of capital while still seeking moderate growth. This goal is achieved through a balanced approach that mitigates risk and provides stability. even during volatile market conditions. A prudent asset allocation typically involves a mix of stocks and bonds, tailored to the investor's risk tolerance, financial goals, and time horizon. The classic approach suggests that a defensive portfolio should maintain a roughly equal split between stocks and bonds, with adjustments based on market conditions and personal circumstances. For instance, during periods of economic uncertainty or declining stock markets, the defensive investor might shift a higher proportion of their portfolio into bonds, which are generally more stable and less volatile than stocks. Conversely, when the market outlook is more optimistic, the investor might slightly increase their stock holdings to capture potential growth. This balanced approach ensures that the portfolio is not overly exposed to the risks associated with any single asset class. Stocks, while offering higher potential returns, are also more volatile and subject to significant short-term fluctuations. Bonds, on the other hand, provide more consistent returns and act as a buffer during market downturns. By combining these asset classes, the defensive investor can achieve a smoother overall performance, with the stability of bonds offsetting the volatility of stocks. Moreover, within the stock and bond categories, further diversification is essential. For stocks, this could mean spreading investments across various industries and geographies, while for bonds, it might involve a mix of government and high-quality corporate bonds. This diversified approach helps to reduce the impact of any single investment underperforming and provides the investor with a more resilient portfolio that can withstand different market environments. Stock selection for the defensive investor. When it comes to selecting stocks, the defensive investor should prioritize safety, stability, and long-term performance. The focus is on choosing companies with strong financial foundations that can weather economic downturns and continue to generate steady returns over time. One of the key criteria for stock selection is financial stability. This includes looking for companies with strong balance sheets, low debt levels, and consistent profitability. A financially stable company is better equipped to manage through challenging economic periods, maintain operations, and continue to pay dividends. By focusing on companies with solid financials, the defensive investor can reduce the risk of investing in businesses that might struggle during market downturns. Another important criterion is the company's dividend record. A history of regular, reliable dividend payments is a strong indicator of a company's financial health and commitment to returning value to shareholders. Companies that consistently pay dividends, even during tough economic times, demonstrate resilience and a shareholder-friendly approach. Dividends also provide a source of income for the investor, which can be especially valuable during periods of low market returns. In addition to financial stability and dividend records, the defensive investor should consider valuation when selecting stocks. It's important to avoid overpaying for stocks, even those of high-quality companies. By focusing on companies that are fairly valued or undervalued relative to their earnings, assets, and growth potential, the defensive investor can build a portfolio that offers both safety and the potential for moderate appreciation. Lastly, the defensive investor should seek out companies with sustainable competitive advantages, often referred to as moats. These could be in the form of strong brand recognition, proprietary technology, cost advantages, or high barriers to entry in their industry. Companies with durable moats are more likely to maintain their market position and profitability over the long term, making them suitable candidates for a defensive portfolio. Bond selection. For the defensive investor, bonds play a crucial role in providing stability and income. The focus should be on choosing safe, high-quality bonds that offer reliable returns with minimal risk. The first guideline in bond selection is to prioritize credit quality. High-quality bonds, such as those issued by governments or well-established corporations with strong credit ratings, are less likely to default and offer more predictable returns. Government bonds, particularly those from stable developed countries, are often considered the safest option, as they are backed by the full faith and credit of the issuing government. Corporate bonds can also be a good choice, provided they are issued by companies with strong financials and a high credit rating. Another important consideration is the bond's maturity. Bonds with shorter maturities tend to be less sensitive to interest rate fluctuations and offer more stability in a defensive portfolio. While longer-term bonds may offer higher yields, they also carry more interest rate risk, meaning their prices can decline significantly if interest rates rise. For the defensive investor, shorter-term bonds, or a laddered approach with staggered maturities, can provide a good balance between yield and risk. Inflation protection is another factor to consider, especially in periods where inflation is a concern. Inflation can erode the real value of fixed income from bonds, so the defensive investor might consider bonds that offer protection against inflation. Treasury. Inflation-protected securities, TIPS, are an example of government bonds that adjust their principal value with inflation, ensuring that the investor's purchasing power is preserved. Diversification within the bond portion of the portfolio is also essential. This can include a mix of government, corporate, and possibly municipal bonds, depending on the investor's tax situation and risk tolerance. By diversifying across different types of bonds, the defensive investor reduces the risk of any single bond or bond category negatively impacting the overall portfolio. Chapter 5. The defensive investor and common stocks. Diversification. Diversification is the bedrock of a defensive investment strategy, particularly when it comes to common stocks. By spreading investments across a variety of sectors, industries, and individual companies, the defensive investor can significantly reduce the risk associated with any single investment. The idea is simple. Don't put all your eggs in one basket. In the world of investing, this means not relying too heavily on a particular company, industry, or market trend to achieve your financial goals. When a portfolio is well diversified, the impact of a poor-performing stock is minimized because losses in one area can be offset by gains in another. For instance, if a particular sector faces a downturn due to economic conditions or regulatory changes, stocks in other, unrelated sectors might perform well, cushioning the overall portfolio from significant losses. This reduces the overall volatility of the portfolio and provides a smoother, more stable return over time. Diversification also allows the investor to participate in the growth of various segments of the economy. By owning a wide range of stocks, the defensive investor captures the overall upward trend of the stock market while being protected from the sharp declines that can occur in any single investment. This approach aligns with the defensive investor's goal of steady, reliable growth rather than seeking outsized returns from a few risky bets. To diversify effectively, the defensive investor should consider spreading investments across different sectors, such as technology, healthcare, consumer goods, and utilities. Additionally, geographic diversification, investing in both domestic and international markets, can further reduce risk by ensuring that the portfolio is not overly exposed to the economic conditions of a single country. Dollar cost averaging. Dollar cost averaging is a disciplined investment approach that involves regularly investing a fixed amount of money into the stock market, regardless of current market conditions. This strategy is particularly well suited for the defensive investor, as it reduces the emotional aspect of investing and helps to mitigate the impact of market volatility. When using dollar cost averaging, the investor buys more shares when prices are low and fewer shares when prices are high. Over time, this results in a lower average cost per share, which can enhance returns and reduce risk. This method also prevents the investor from trying to time the market, which is notoriously difficult and often leads to poor investment decisions. For example, if the market experiences a downturn and stock prices fall, the fixed amount of money invested will purchase more shares than it would during a market peak. Conversely, during market upswings, the same fixed amount buys fewer shares. Over the long term, This strategy smooths out the effects of market fluctuations and can result in a more favorable average purchase price. Dollar-cost averaging also encourages consistency and discipline, key traits for the defensive investor. By committing to invest a set amount at regular intervals, the investor avoids the common pitfalls of trying to predict market movements or making decisions based on short-term emotions. This consistent approach aligns with the defensive investor's focus on steady, long-term growth rather than chasing quick gains. Moreover, dollar-cost averaging is particularly beneficial in volatile markets. It reduces the risk of investing a large sum of money at a market peak, which could lead to significant short-term losses. Instead, by spreading investments over time, the investor can gradually build a position in the market and take advantage of different market conditions. Avoiding high-risk stocks. For the defensive investor, avoiding high-risk stocks is a fundamental principle. High-risk stocks are often characterized by volatile price movements, uncertain business models, or speculative growth prospects. While these stocks might offer the potential for substantial gains, they also carry a significant risk of loss, which is contrary to the defensive investor's primary goal of preserving capital. One of the key risks associated with high-risk stocks is their unpredictability. These stocks often belong to companies that are in the early stages of development, operate in highly competitive or rapidly changing industries, or have weak financials. While these companies might have exciting growth potential, they are also more susceptible to failure or significant downturns if their business model doesn't succeed, or if external conditions change unfavorably. The defensive investor should prioritize stability and long-term viability when selecting stocks. This means focusing on companies with a proven track record, strong financials, and a stable business model. Companies that have been around for a long time, consistently generate profits, and have a history of weathering economic cycles are more suitable for a defensive portfolio. Another risk of high-risk stocks is their susceptibility to market speculation. Stocks that are heavily hyped by the media or social trends can experience sharp price increases, often followed by equally sharp declines when the hype fades or when the underlying business fails to meet inflated expectations. Defensive investors should be cautious of stocks that appear to be overvalued or that have risen rapidly without a corresponding improvement in their fundamental business performance. In addition, defensive investors should be wary of stocks in sectors that are particularly prone to rapid changes, such as technology startups, biotech companies, or firms in emerging industries. While these sectors might offer high growth potential, they also come with higher uncertainty and risk, which is not aligned with the defensive investor's strategy. Instead, the defensive investor should focus on established companies with strong brands, reliable earnings, and a commitment to shareholder returns, such as regular dividends. These companies are more likely to provide consistent returns and less likely to suffer from the dramatic price swings that characterize high-risk stocks. Chapter 6. Portfolio Policy for the Enterprising Investor. The Positive Side. Investment Opportunities. The enterprising investor, unlike the defensive investor, is always on the lookout for unique investment opportunities that offer the potential for above-average returns. This approach requires a deeper level of analysis, a willingness to embrace risk, and the ability to identify value where others might overlook it. One of the most promising avenues for the enterprising investor is the pursuit of undervalued stocks. These are stocks trading below their intrinsic value, often due to temporary setbacks, market inefficiencies, or negative sentiment. The enterprising investor has the patience and foresight to recognize that these companies are fundamentally sound and likely to recover or improve, providing substantial returns as the market eventually corrects its undervaluation. Another area of interest is special situations. These are scenarios where specific corporate events, such as mergers, acquisitions, restructurings, or spin-offs create opportunities for profit. For example, a company undergoing a restructuring might temporarily see its stock price depressed due to uncertainty or short-term challenges. However, if the enterprising investor can accurately assess the situation and predict the positive long-term outcome, they can capitalize on the eventual recovery and growth. Similarly, spin-offs can present opportunities to invest in newly independent companies that may have been undervalued as part of a larger entity. Arbitrage is another strategy that the enterprising investor might explore. This involves taking advantage of price discrepancies between different markets or financial instruments. For instance, in the case of a pending merger or acquisition, the enterprising investor might buy shares of the target company at a discount, betting that the deal will go through and the share price will rise to the agreed-upon acquisition price. While arbitrage opportunities are often short-lived and require precise timing and execution, they can provide a relatively low-risk way to achieve returns when done correctly. Growth stocks. Growth stocks represent another attractive opportunity for the enterprising investor. These are shares in companies that are expected to grow significantly faster than the overall market, often because they operate in dynamic industries or have innovative products or services. The potential for high returns makes growth stocks appealing, but they come with increased risk. The enterprising investor must carefully evaluate the potential and risks associated with these stocks. Investing in growth stocks requires a thorough understanding of the company's business model, market position, and growth prospects. The enterprising investor should look for companies with strong revenue growth, expanding market share, and competitive advantages that can sustain growth over the long term. However, it is also crucial to be aware of the risks. Growth stocks often trade at high price-to-earnings (PE) ratios, reflecting investor optimism. If the company fails to meet the high expectations built into its stock price, the enterprising investor could face significant losses. Additionally, growth stocks are often more volatile than other types of investments. Their prices can fluctuate dramatically based on news, market sentiment, or quarterly earnings reports. Therefore, the enterprising investor must be comfortable with this volatility and have the conviction to hold through short-term downturns, provided the long-term growth story remains intact. Convertible issues. Convertible securities, such as convertible bonds and preferred stocks, offer the enterprising investor a hybrid investment that combines the benefits of fixed income securities with the potential for equity-like returns. Convertible bonds, for example, are debt instruments that can be converted into a predetermined number of the issuing company's shares. This feature allows the enterprising investor to benefit from the relative safety and income of a bond, while retaining the option to participate in the upside if the company's stock performs well. The merit of convertible issues lies in their ability to provide a measure of downside protection, as the bond component ensures that the investor receives regular interest payments and has a claim on the company's assets in case of bankruptcy. However, if the company's stock price rises significantly, the conversion feature allows the investor to convert the bond into shares and potentially realize substantial capital gains. Convertible preferred stocks work similarly, but typically offer a fixed dividend and can be converted into common shares under certain conditions. For the enterprising investor, these securities can be an attractive way to balance income with growth potential, particularly in companies where they see strong long-term prospects but want to mitigate the risks associated with direct stock ownership. Chapter 7. The Enterprising Investor and Market Fluctuations. Market timing. Market timing, the practice of attempting to predict market movements and buy or sell stocks accordingly, is a tempting strategy, but one fraught with pitfalls. The enterprising investor is advised against relying on market timing due to its inherent unpredictability. Even the most seasoned investors struggle to consistently predict market highs and lows, as stock prices are influenced by a multitude of factors, including economic data, geopolitical events, and investor sentiment, all of which are difficult to forecast with accuracy. Instead of trying to time the market, the enterprising investor should focus on the underlying value of the investments. This approach involves making decisions based on fundamental analysis rather than short-term price movements. By concentrating on buying high-quality assets at reasonable prices, the enterprising investor can build a portfolio that is resilient to market fluctuations and less dependent on the whims of market timing. Value investing. The cornerstone of the enterprising investor strategy is value investing. This approach involves purchasing stocks that are trading below their intrinsic value, based on a thorough analysis of their financials, management, and market position. The key to successful value investing is patience and discipline. The enterprising investor must be willing to conduct deep research to identify stocks that are undervalued by the market, and then wait for the market to recognize their true worth. Value investing is about finding opportunities where the market has overreacted to short-term challenges or where a company's potential is underappreciated. By focusing on the intrinsic value of a stock, the enterprising investor can avoid the pitfalls of speculative investing and instead build wealth through steady, long-term appreciation. It's important to note that value investing is not about chasing the cheapest stocks, but about finding quality companies whose stocks are trading at a discount to their true value. This distinction is crucial, as investing in poorly managed or fundamentally weak companies simply because their stocks are cheap can lead to poor outcomes. Margin of safety. A critical concept for the enterprising investor is the margin of safety. This principle involves buying stocks at a significant discount to their intrinsic value, thereby providing a cushion against errors in analysis, market volatility, or unforeseen adverse events. The margin of safety acts as a protective barrier, reducing the risk of loss and increasing the likelihood of a positive investment outcome. The enterprising investor should always seek to buy with a margin of safety, ensuring that even if the stock doesn't perform as expected, the downside is limited. This approach is particularly important in volatile markets, where stock prices can fluctuate widely due to factors beyond a company's control. By purchasing stocks with a margin of safety, the enterprising investor not only positions themselves for potential upside, but also protects their capital against significant downturns. In practical terms, the margin of safety might involve looking for stocks that are trading at a significant discount to their book value, earnings potential, or other fundamental measures. It's a way of building a buffer to account for the inherent uncertainties in investing, such as economic shifts, changes in interest rates, or company-specific issues. Chapter 8. The Investor and Market Fluctuations. Mr. Market, the allegory. In the world of investing, the market often behaves like a whimsical and emotional character, one who is prone to unpredictable swings in mood. This character can be imagined as Mr. Market, an allegory that helps investors understand the irrational behavior often exhibited by the stock market. Mr. Market shows up every day with an offer to buy or sell shares at different prices, which can vary wildly based on his emotional state. Sometimes euphoric and willing to pay far above intrinsic value, and other times deeply pessimistic, offering prices far below what a company is truly worth. The key takeaway from this allegory is that Mr. Market's opinions and prices are not necessarily reflective of the true value of the underlying assets. His mood swings are driven by short-term events, speculation, and overall market sentiment, rather than a rational assessment of the long-term prospects of the companies in question. As an investor, you have the power to choose whether to act on Mr. Market's offer. The wise approach is to use Mr. Market's emotional fluctuations to your advantage, buying when he is overly pessimistic and selling when he is excessively optimistic. The goal is to remain detached from his erratic behavior and make decisions based on sound analysis rather than emotion. Rational investing. In a world where the market is often driven by fear and greed, the most successful investors are those who maintain their composure and remain rational. Rational investing involves making decisions based on careful analysis, logical reasoning, and a long-term perspective, rather than being swayed by the emotional ups and downs of the market. It's about understanding that the intrinsic value of a company doesn't change dramatically from day to day, even if its stock price does. Rational investors recognize that market fluctuations are a natural part of investing. They don't panic when prices fall, nor do they become overly enthusiastic when prices rise. Instead, they focus on the fundamentals of the companies they invest in, considering factors such as earnings, dividends, and growth prospects. By staying calm and sticking to a well-thought-out investment strategy, rational investors can avoid the common pitfalls of buying high and selling low, which are often driven by emotional reactions to market movements. This approach requires discipline, patience, and the ability to tune out the noise of the market. It also involves understanding that short-term volatility is not necessarily indicative of long-term value. Rational investors are more concerned with where a company will be in 5 or 10 years than with where its stock price is today or tomorrow. Investment policy. One of the most important principles for any investor is the need to stick to a disciplined investment policy. This means having a clear, well-defined plan that guides your investment decisions, regardless of market conditions. A disciplined investment policy should be based on your financial goals, risk tolerance, and time horizon, and it should remain consistent even in the face of market volatility. The idea is to avoid making impulsive decisions based on short-term market fluctuations. For example, during a market downturn, a disciplined investor wouldn't panic and sell off their holdings at a loss. Instead, they would stick to their plan, perhaps even seeing the downturn as an opportunity to buy quality assets at lower prices. Similarly, during a market boom, they wouldn't abandon their strategy to chase after speculative investments that don't align with their long-term objectives. Sticking to a disciplined investment policy helps to mitigate the influence of emotions and ensures that decisions are made with a clear head. It's about having the confidence to trust in your strategy, even when the market is sending mixed signals. This approach not only helps protect against the risks of emotional investing, but also increases the likelihood of achieving your long-term financial goals. Chapter 9. Investing in investment funds. Mutual funds are a popular investment vehicle that allows individuals to pool their resources to invest in a diversified portfolio of stocks, bonds, or other securities. One of the key advantages of mutual funds is their accessibility and convenience. They offer an easy way for investors, especially those with limited time or expertise, to achieve diversification and professional management of their investments. However, mutual funds also have their disadvantages. One of the main drawbacks is the fees associated with them, which can include management fees, administrative costs, and sometimes even sales charges. These fees can eat into the returns that investors receive, especially in funds that are actively managed, where the costs tend to be higher. Additionally, not all mutual funds are created equal. Some may have high turnover rates, leading to increased taxes for investors, or they may underperform their benchmarks despite charging high fees. When considering mutual funds, it's important to look beyond just the past performance, which is often highlighted in marketing materials. While historical returns can provide some insight, they do not guarantee future results. Instead, investors should evaluate the fund's investment strategy, the experience and track record of the management team, the fund's expense ratio, and how well the fund's objectives align with their own investment goals. Investment trusts are another type of pooled investment vehicle, similar to mutual funds, but with some key differences. Unlike mutual funds, which issue and redeem shares on demand, investment trusts are closed-ended, meaning they have a fixed number of shares that are traded on the stock exchange. This structure can lead to greater flexibility for the fund manager, as they don't have to worry about meeting redemption requests during market downturns. One of the benefits of investment trusts is their ability to leverage. They can borrow money to invest, potentially enhancing returns. though this also increases risk. Investment trusts also tend to have lower management fees compared to mutual funds, and because their shares trade on the stock exchange, they can sometimes be purchased at a discount to the net asset value, NAV, of the underlying investments. However, investment trusts come with their own set of risks. The use of leverage can amplify losses during market downturns, and the fact that they are closed-ended means their shares can trade at a premium or discount to the NAV, leading to potential volatility in share prices. Investors considering investment trusts should carefully evaluate the trust's management, fee structure, and investment strategy, as well as their own risk tolerance. Evaluating fund performance. When selecting a mutual fund or investment trust, it's crucial to evaluate fund performance based on a comprehensive set of criteria. While past performance is one aspect to consider, it should not be the sole factor. Investors should look at the consistency of the fund's returns over different time periods, particularly during market downturns, as this can provide insight into how the fund might perform in various market conditions. Another important factor is the fund's expense ratio, the total annual cost of owning the fund, expressed as a percentage of the fund's assets. Lower expense ratios are generally better, as they leave more of the returns in the investor's pocket. However, it's also important to consider what you're getting for that fee. A higher fee might be justified if the fund provides exceptional management or access to unique investment opportunities. The quality and experience of the management team are also critical. A fund's performance is largely dependent on the decisions made by its managers, so it's important to choose funds that are managed by experienced, well-regarded professionals with a track record of success. It's also worth considering whether the management team has a significant personal investment in the fund, as this can align their interests with those of the investors. Lastly, consider the fund's investment strategy and how well it aligns with your own investment objectives and risk tolerance. Some funds may focus on growth, others on income, and still others on preserving capital. Understanding the fund's strategy will help you determine whether it's the right fit for your portfolio. Chapter 10. The problem of large-scale enterprises. Corporate governance. In the world of large-scale enterprises, corporate governance plays a pivotal role in ensuring that companies are run efficiently and ethically. Governance structures outline the rules, practices, and processes by which companies are directed and controlled. Effective governance involves a board of directors that oversees management, ensures accountability, and aligns corporate strategies with the interests of shareholders and other stakeholders. Investors should be keenly aware of corporate governance because it directly impacts the performance and integrity of a company. Good governance practices promote transparency, protect shareholder interests, and enhance long-term value. Investors should look for companies with robust governance frameworks, such as independent board members, clear policies on executive compensation, and mechanisms for shareholder engagement. Companies with poor governance practices can face issues like management misconduct, financial misreporting, and strategic failures, which can adversely affect stock performance. Shareholder rights are a fundamental aspect of investing in large corporations. Shareholders, as owners of the company, have the right to vote on key matters, including the election of directors, mergers, and significant changes in corporate strategy. They also have the right to receive timely and accurate information about the company's performance and operations. Understanding and exercising these rights is crucial for influencing corporate policies and ensuring that management acts in the best interests of shareholders. Investors should be proactive in voting on shareholder resolutions and engaging with the company to address any concerns. Companies that respect and uphold shareholder rights are more likely to foster a positive relationship with their investors and operate with greater accountability. Management quality. Evaluating management quality is essential when selecting stocks, especially in large-scale enterprises. The effectiveness of a company's management team can significantly impact its performance. strategy, and long-term success. Key indicators of management quality include their track record, experience, and ability to execute the company's vision and strategy. Investors should assess the background of top executives, their past achievements, and their approach to corporate governance. Effective managers demonstrate a clear vision for the company, make strategic decisions that enhance shareholder value, and operate with integrity and transparency. Scrutiny of management quality helps investors avoid companies where leadership may be lacking or where there might be potential conflicts of interest. Chapter 11. Security Analysis for the Lay Investor. Fundamental Analysis. For lay investors, fundamental analysis is a crucial tool for evaluating a company's financial health and potential for growth. This involves examining a company's financial statements, income statement, balance sheet, and cash flow statement to assess its profitability, financial stability, and cash flow. Income statement provides a snapshot of the company's revenue, expenses, and profits over a specific period. Investors should look for consistent revenue growth and profitability, as well as an understanding of cost structures and margins. Balance sheet offers a view of the company's assets, liabilities, and equity at a specific point in time. Key metrics to analyze include the company's debt levels, asset utilization, and equity position. A strong balance sheet indicates financial stability and the ability to weather economic downturns. Cash flow statement details the cash inflows and outflows from operating, investing, and financing activities. Positive cash flow from operations is a good indicator of a company's ability to generate cash and fund its operations without relying on external financing. Earnings power. Assessing earnings power involves evaluating a company's ability to generate consistent and sustainable profits over time. This metric is crucial for understanding the company's future earning potential and overall financial health. Key factors to consider include historical earnings, performance. Reviewing past earnings can provide insight into the company's stability and growth trajectory. Consistent earnings growth suggests a robust business model and competitive advantage. Earnings quality. It's important to distinguish between genuine earnings and those that are influenced by accounting adjustments or one-time events. High-quality earnings are sustainable and derived from core business operations. Valuation techniques help investors determine whether a stock is priced fairly compared to its intrinsic value. One commonly used method is the price-to-earnings (PE) ratio, which compares a company's current share price to its per-share earnings. PE ratio, calculated as the current stock price divided by the earnings per share, EPS. A lower PE ratio may indicate that a stock is undervalued relative to its earnings, while a higher PE ratio might suggest overvaluation. However, the PE ratio should be considered in the context of industry norms, growth prospects, and other financial metrics. Investors should also explore other valuation methods, such as discounted cash flow, DCF, analysis, and price-to-book, PB ratios, to gain a comprehensive understanding of a stock's value. Proper valuation helps investors make informed decisions and avoid overpaying for stocks based on speculative or transient market conditions. Chapter 12. The margin of safety as the central concept of investment. The margin of safety is a fundamental investment principle that serves as a protective buffer against uncertainties and risks. It refers to the difference between the intrinsic value of an investment and its market price. Essentially, it is the amount by which the investment price is below its estimated true value. This cushion helps to mitigate potential losses if the investment does not perform as expected, or if there are unforeseen adverse conditions. The margin of safety is crucial because it accounts for errors in estimation and unforeseen market fluctuations. By investing with a margin of safety, investors are not only seeking to safeguard their capital, but also to enhance their potential for returns. This principle ensures that even if the investment analysis is flawed or external conditions change, the investor's downside risk is minimized. Application of margin of safety. Applying the margin of safety concept involves evaluating investments to ensure they are purchased at a price significantly lower than their intrinsic value. This practice can be applied across various types of investments, including stocks, bonds, and real estate. Stocks. For stocks, the margin of safety is determined by comparing the stock's current market price to its intrinsic value, which is estimated through fundamental analysis. An investor would seek stocks trading at a substantial discount to their intrinsic value, providing a margin of safety that accounts for potential errors in valuation and market volatility. Bonds. In the bond market, the margin of safety involves purchasing bonds with a high credit rating and at a price that ensures a sufficient yield relative to their risk. Investors should also consider factors such as the bond issuer's financial health and the bond's maturity date. Real estate. When investing in real estate, the margin of safety can be assessed by buying properties at prices below their estimated market value or replacement cost. Additionally, evaluating the property's income potential and market conditions helps ensure a margin of safety. In each case, the margin of safety provides a cushion against adverse outcomes and increases the likelihood of achieving satisfactory investment returns. Case studies. Historical examples demonstrate the effectiveness of the margin of safety in protecting investors. Case study. 1. The Great Depression. During the Great Depression, many stocks and bonds plummeted in value. Investors who adhered to the margin of safety principle, buying assets well below their intrinsic value, were better positioned to withstand the market turmoil and eventually saw significant gains as the market recovered. Case Study 2. The dot-com bubble. During the late 1990s, the technology sector experienced a speculative boom, followed by a dramatic collapse. Investors who had applied a margin of safety by avoiding overpriced tech stocks or those with unsustainable business models were less impacted by the subsequent crash and were able to capitalize on value opportunities when the market corrected. Case Study 3. The Financial Crisis of 2008. In the aftermath of the 2008 financial crisis, many financial institutions and real estate assets were deeply undervalued. Investors who had been cautious and bought assets at significant discounts to their intrinsic value found themselves in a strong position as the market rebounded. These case studies highlight how the margin of safety concept helps investors navigate periods of high uncertainty and volatility, offering protection against losses and providing opportunities for substantial gains. Conclusion. The basic lessons of the book. One of the central lessons emphasized throughout the book is the importance of maintaining a long-term perspective in investing. Successful investing is not about chasing short-term gains or reacting impulsively to market fluctuations. Instead, it's about focusing on the long-term potential of investments and allowing time for those investments to grow and realize their value. Patience and a long-term outlook are essential for weathering market volatility and achieving sustainable financial success. Disciplined approach. Adhering to a disciplined approach is another key lesson. Discipline involves sticking to a well-defined investment strategy and making decisions based on careful analysis rather than emotions or market trends. This approach includes setting clear investment goals, following a consistent investment plan, and avoiding the temptation to deviate from the strategy in response to short-term market movements. A disciplined approach helps investors stay focused on their objectives and reduces the risk of making hasty or poorly informed decisions. Staying rational. Finally, the book underscores the importance of staying rational in the face of market volatility. Emotional reactions, such as fear during market downturns or greed during market upswings, can lead to irrational decisions that undermine long-term investment success. Rational investing means making decisions based on objective analysis and a clear understanding of market conditions and investment fundamentals. By maintaining emotional detachment And relying on a rational approach, investors can avoid common pitfalls and stay on track to achieve their financial goals. In summary, the basic lessons of the book revolve around maintaining a long-term perspective, adhering to a disciplined investment strategy, and staying rational to navigate the complexities of the investment world successfully. These principles are essential for building a robust investment portfolio and achieving lasting financial success.